Typically, yes. Okay.
Pues muy buenas tardes a todos, un gusto en saludarlos. Yo soy Juan Carlos Herrera, Chief of Advisory and Investment Solutions en GBM. Y en esta plática vamos a platicar un poco de portafolios modelos. Aquí acompañándome está Joe Nelesen, Head of Specialists en S&P Dow Jones Indices, que nos va a compartir la visión global sobre cómo están creciendo los portafolios modelo, por qué los índices y ETFs han tomado tanto protagonismo y qué dice la data más reciente sobre el desempeño de la gestión activa versus pasiva. Y acompañándonos también está Andrés Maza, Chief Investment Officer de GBM, quien lidera el equipo y diseña y gestiona nuestros portafolios modelo y que ha sido pieza clave para crecer los portafolios modelos en México. Gracias por acompañarnos. Thank you for joining us, Joe. Voy a cambiar ahora en inglés con Joe. Nos visita desde Nueva York. Y si queremos, we'll start with you, Joe. Just told everyone we're switching to English. You got it here from New York.
My problem. It's my fault. Yes, thank you. Yes, came from New York.
Welcome to Mexico.
Thank you.
So, Joe, what is happening in more developed markets like the U.S. regarding the advisor's role and the use of model portfolios?
I've been thinking about this a lot, and if you'll indulge me and let me go back in time a little bit, because even up to now and even on the plane, I was thinking about all these really interesting numbers, but one that came to mind on this question is 24. 24 years ago today, what happened in New York. And sorry to start on a dark note, but here we are. I think it's important because I was in New York City and shortly after that too, and the thing that struck me as it pertains to advisors, and I will come back to the question here, is really this is about people. The role of an advisor and ETF models and what we're going to talk about has a lot to do with people and the clients. And I think about that because walking around the city after what happened, you could look people in the eyes, strangers you didn't know, right? And you'd say, how are you doing? They'd say, I'm fine, right? But you'd see that they're not fine. And I think if anybody is people you love, people your friends, you ask them how they're doing, they say, I'm fine. And there are times that you know that they're not. And it makes me think a lot about what an advisor is really supposed to do. Surveys have shown, we've seen studies that have shown what clients really want to hear is not what is the next big investment, how do I outperform the market? There is some of that, but more importantly in surveys, they say, I want someone who understands how I think about risk, what I'm worried about, what my goals are for myself and my family. And
have you seen since in those 24 years, have you seen a change in how investors are talking to their advisors, or the change of the advisor, of how he's changed and evolved to maybe do more planning? Or
I mean, I'm not an advisor myself, but I talk to them all the time and I encounter them all the time. And I think what's happened for me, I think and others too, is obviously over this 25 years we've had this massive innovation revolution, right? Artificial intelligence, robo trading before, whatever we want to call it. All of these things that can make the process of investing, the mathematical side of it, easier, and that's true. But I think that more and more, you see this in studies too, the number of people who are interested in having an advisor now versus trading themselves is increasing, right? People are going back to wanting someone to help guide them through this. And going back to the role of an advisor today as it has to do with models is, I think, about scale. Because if more people are coming to you, more people want your advice, more people want you involved with what their family is involved with, then you need to scale the investment side. And you can do that through indexing, models, ETFs, with the help of a provider. I think that's the revolution we're seeing, is there's automation and personalization without that loss of emotion.
Andres, in the 20 years, I don't know if you've been with GBM for 20 years, or how long have you been in GBM?
Almost 17, so yeah, close to
20 years. We can say 20 years. So in the 20 years you've been at GBM, how do you contrast what Joe's saying in terms of the advisor and the client relationship, and what investors are looking for from an advisor?
Yeah, sure. I think I would say it's a similar story, although perhaps in Mexico we're a few years behind probably more developed markets like the US or Europe, where this new conception of the role of the advisor, with the role of the advisor, or the advisor should be focused on helping the client set goals, reach them, probably lead them to the right portfolio in line with those goals, but not necessarily be, some sort of portfolio manager that's doing, moving the portfolio every day, pitching trades, things like that, right? So I think, and certainly that's in line with our philosophy here at GBM, but I think there's also something that's happening in the market more broadly in Mexico. And in the case of GBM, something or a solution that has also, helped us move along that goal is the implementation of these model portfolios, right? It's something that, as I said, probably in markets like the US or Europe, is definitely more advanced or more far along. But we've also seen it grow very much in GBM, and it's actually become one of our most popular solutions among our teams of advisors in terms of how to structure a portfolio for their clients, right? I'm sure, given the pace of growth or the pace of adoption we're seeing with these types of strategies or with these types of models, that it's only going to be more and more popular as we continue to move forward.
Can you go into a little bit more detail, though? Maybe our audience is not that familiar with what model portfolios are.
Sure. A model portfolio is basically a set of products, a portfolio, a group of different instruments, for example, ETFs, that are built with a certain objective in goal. For example, a certain objective in terms of providing a client with a balanced portfolio with the right mix of assets that provided with a certain behavior, a certain level of risk, targeted to a certain outcome, and that is, at least in the case of GBM, something that is centrally developed and managed, and that we then offer to all of our advisors and clients, so they can use this solution sort of as a turnkey, let's say, solution in terms of how to invest the client's money within an investment account in GBM. So instead of the old model where probably an advisor would select securities, different types of instruments, and build a specific portfolio for each client, here we're also, of course, taking in mind the particular needs of each client, the particular risk tolerance, his objectives, his time horizon, etc. But we're using preset or predefined components to build this investment solution for the client.
And Joe, so for model portfolios and the evolution that they've had, I think if you see it from a client's perspective of maybe an advisor before, like Andres said, of just recommending stocks and bonds that the advisor believes are a good investment, but not really understanding what the client's objectives are, how do you think model portfolios add value to more aligning a client's objective to, say, an investment portfolio?
I think the models can remove some of the human bias that we have, that the advisor would face as well in doing stock and bond selection, right? And getting that scale. The customization of models has increased dramatically, right? So every kind of risk tolerance, every kind of niche exposure someone wants can be achieved now through most of these models. But more importantly, let me tell you another story around why this is hard, and this feeds into what we do in some of our research. If you go again back to 2001, November, right? I keep going back in time here, but it's a good way to follow up to where we are today. There was a company called Enron If you've heard, remember Enron, it was the darling of the stock market. Everyone wanted to own Enron until about 2000, right, when all of the scandals came out. It was outperforming, and so everyone looked smart who owned it until they didn't. It was plummeting. Eventually, the S&P 500, the index that we run, removed Enron in November of 2001 and replaced it with a little tiny stock called NVIDIA. Makes semiconductors. Maybe you have never heard of NVIDIA, but it grew into a big thing. But when NVIDIA added to the S&P 500, it was only like 9 basis points of weight. Tiny, right? Almost in the middle, hardly noticeable, right next to a little company called Apple, really obscure. Also, together with Apple, it was about 7 basis points. So together, their weight was tiny. Apple was still at least 5 years away from introducing the iPhone, right? It wasn't clear that those two companies would become some of the top weights that they are today and produce what they have. And I bring this up because to show how difficult it would have been, and by the way, both of them underperformed the market for a couple of years after they were added, right? So it's easy to say I would have added that, I would have picked this stock, but no one really knew what would happen. And we bring that up in the context of our SPIVA research sometimes around how hard it is to pick individual stocks, and it reminds me of the phrase, if you can't beat them, join them. If you can't beat the market, just own the market. And that's what is happening with models, is owning parts of markets around the world in a rational, customized risk exposure for each individual client.
And I think owning the market is not maybe well understood sometimes, meaning the market is, the sum of all investors, right? And so maybe, Andres, can you explain to us why, say, owning the market in a cap-weighted way is maybe different, and then how you rebalance owning the market, as Joe said, by having securities in an era that maybe are not there anymore in another era, versus just maybe having an equally weighted portfolio that's not really a market portfolio?
Yeah, sure. I mean, a lot of research shows, right, that basically what Joe was mentioning, that owning the market is an approach that works well for investors, that ensures that they don't necessarily be either subject to particular biases, that they won't be perhaps distracted by following specific opportunities, but also won't miss out on some opportunities that would have been very difficult to identify at the beginning, that may seem obvious looking back, but that were definitely not obvious going forward. Owning a market is a way to diversify, but at the end of the day, what we always look at is the financial markets are composed of a whole variety of instruments, right? There's the stock markets, there's the US stock market, there's Mexico, there's Europe, there's different regions, there's different sectors, there's other asset classes like bonds, probably real estate, REITs, etc. And at the end of the day, you want to make sure as an investor you have a diversified solution, but also that solution is tailored to specific needs and goals. So what we've built at GBM is a range of assets that are broadly diversified across the market, but also reflect different types of exposures, so that an advisor can take these tools, give the client this broad diversification, but also lower and raise exposures to the particular asset classes that are going to drive the result that the client, that his risk profile is looking for.
In taking that, I know Standard & Poor's has done a great job with the SPIVA, right? Is how he says, SPIVA.
SPIVA, you got it.
Research arm. I look at that a lot. How does, what is it you guys are doing in that research arm in relating to model portfolios and indexes overall?
Sure. So SPIVA, if you don't know it, stands for S&P Indices versus Active. And it is a body of research we've been doing for over 20 years now. We started in the US, we've expanded to every other market, including Mexico and most of Latin America, where every year we look at the performance of all of the active mutual funds that we can find, equity, fixed income, emerging, developed, you name it, and compare them to their benchmarks and see over 1 year, 3, 5, 10, 15 years, how many of them underperformed? Because this is the question people asked with the growth of index investing. Is this giving up performance? Am I giving it up versus someone who's smart and can pick stocks? And there are very smart people who can do this kind of job. But what we find is a result that is consistent around the world, which is that most of the time in most markets, most managers underperform. In Mexico, for example, last year when we did the last version, over 10 years, 82% of Mexico equity managers underperformed the benchmark, the IPC, right? And it gets even worse in some of the categories in the US equity, world equity. But what was interesting, though, was over the short term, over 1 year, actually the majority of Mexico equity managers outperformed. And we were curious about that. Thought, how did they do it? And so we went in and examined, the top 25%, the outperforming managers. What did they have in common? And the thing that they had in common was that they all owned ETFs in those portfolios, right? So not just Mexican equities, they owned US ETFs, European real estate ETFs, all kinds of things. So it was almost like they were kind of doing a model in disguise, some of the best performing funds, which to me was really testament that this kind of approach works. But going back to SPIVA, really the point of it is we know there are times that active managers can do well in different markets. People use them in portfolios. But the fact is, that I gave you the example of NVIDIA. There are many others that are hard to predict. There are fees that are higher that make it very difficult to build a outperforming portfolio of active funds over time.
But I guess the results are pretty consistent in every country, that the more time goes by, the less managers are being, outperforming those benchmarks.
Yeah, there's a convergence, right? So you see some wide differences over 1 year. They start to narrow. When you get out to 10 or 15 years, most of the managers that remain, and by the way, about 50% or more in some categories disappear over that period of time. Those that remain tend to be more similar, but they tend to be more similar and slightly below the benchmark after fees that the investor has to pay. And so the question people have is then, well, why don't I just own the benchmark that most of them are underperforming? That seems to be a viable approach. And given the prolific growth of ETFs, it's not just owning the whole market around the world in cap weight. You can do value, growth, sectors, countries, right? There are a lot of ways to use these passive index instruments in ways that are completely tailored to individual clients through a model provider, and then recognizing that indexes have outperformed most managers over time.
I think the word, I think before I get to you, one more question for you, Joe. So on that note, why not just then, pick managers that have done well? Like, if we already know which ones are doing well, is there persistence of those managers?
Well, that's the question that followed when we started to publish SPIVA, right? Exactly. People would say, I don't just pick a random manager, I pick the good ones, right? Seems rational. So we started use the word persistence. We started writing something called the persistence scorecard, which is a follow-on version of SPIVA where we say, let's look at the top performing funds in every category and see what happens to them going forward. Again, in Mexico, for example, if you went back to just 3 years ago and took the top quartile Mexico equity funds and followed them just 2 more years, you would find that 40% of those funds fell to the bottom, right? Some of them stayed at the top, but even being in that top quartile was not a guarantee of outperformance. More broadly around the world, if you look at top quartile funds across all categories, fixed income, equity, US, Europe, everywhere, it's around 5,000 funds in our global SPIVAs. Of those 5,000, how many of them stayed in the top quartile for just 3 years? It was just 6%. So now you're facing this challenge as a fund selector, as an advisor or a consultant, whoever you are, to say, do I have the ability to predict someone's future performance based on the past? Because evidence is showing that the past performance doesn't have a lot of relationship to how that manager will do. And that, I think, is one of the most surprising results in all of the research that we've done.
That's very interesting. And I think, following up on that, Andres, I think the word passive and active kind of are loosely, especially the word passive when it comes to talking maybe about specifically ETFs. Can you elaborate more a little bit about, what maybe passive should mean versus, say, especially when it relates to ETFs nowadays, when there's a lot of ETFs now that some investors and some advisors might think that they're passive in nature?
Yeah, sure. The ETF landscape is huge currently. There are, I don't know the precise number in the US, but there are literally thousands of ETFs, and more are coming to the market every day. We actually now have active ETFs even that replicate what fund managers used to do in mutual funds, for example, and now offer it through an ETF wrapper. And there's a huge variety. And at the end of the day, or the way we approach it in GBM, is that we want to make sure we have different solutions that provide different exposures. We want to use instruments like ETFs, although we don't always use ETFs for the implementation of these strategies. For example, we want to be benchmarked to an index, for example, like the S&P, like Joe was mentioning. But sometimes we replicate this through individual securities, for example, depending on exposure. At the end of the day, we always want to compare to a benchmark to make sure that the portfolio is behaving the way it should be, that it's bringing the results we want to be, that it's performing in line with a certain return profile or a certain risk profile. But what we do is we enable a lot of these different solutions, and we offer to clients what really is a very wide menu and flexible menu. You know, sometimes people could think, you know, a model portfolio is going to mean, you know, probably more constraints, right? I used to pick every single stock, every single bond, every single security one by one, and now I'm adhering to a particular model. And yeah, models in particular are probably geared towards selecting a few ETFs, providing a certain exposure, following a certain index, for example. But the variety of the different models that we offer allow us to cater to different client needs, allow advisors to have actually a very flexible offering, and at the same time allow us at GBM to make sure that our clients also have a very homogeneous offering in terms of the expected results that they should obtain, in terms of having the right results, for example, in comparison to a benchmark. And also, this approach, and I think we discussed this briefly also at the beginning, but it also frees a lot of time for the advisor to actually focus on what the advisor does best, which is, you know, advising the client, understanding his needs, setting the right goals, etc. Right? So that's the way we approach it.
And I think that personalization, I think, is what is important to, like you said, letting the advisor advise more and not worry so much about the actual, you know, nuances of the investments themselves from the day to day. Joe, what kind of metrics can we share around adoption of this in maybe like the States?
Yeah, model growth. It's been tremendous. And by the way, one point Julio made that was interesting is around, you know, the growth of ETFs. I saw something from Bloomberg that today there are actually more ETFs than stocks in the United States. There are more ETFs trading than stocks trading, right? So, and I'm fine with
ETF
that.
for everything. Now.
There is, and that's okay, and it's not a problem, right? And the way it was phrased is that many of those are trades. They're kind of packaged. There might be levered position on Tesla or value in sector, whatever. So there's these tailored exposures, but they're very transparent, and they can be used for very precise portfolio construction. The growth of the model business in general, a lot of these statistics are very much U.S. based because that's where, you know, Cerulli and others are doing some research. Right now, they're estimating around $1.9 trillion in asset allocation models. The expectation is that will grow to around 2.9 by the end of 2026. That's tremendous growth, more than 50% over a year. So the number of models is growing, the amount of assets in those models is growing. I think for other surveys we see around advisors, around 75% of advisors say they prefer to use a model for client accounts of $500,000 or less, right? It always makes sense for smaller accounts where, you know, you can manage the sizes better with ETF models. But what's growing fast is in the $500 to $5 million range of accounts. There's a massive increase in advisor pickup of models there too. And so, again, I think it's all a holistic math problem where more people are seeking advice, more people need a really tailored personal approach around understanding their risk and their goals and what's really behind their eyes and not just their words. And the advisors need scale, and they're getting that through model providers who have a wide range of customization that'll help that advisor's clients every day.
And I think scale is like the key word. Are you seeing the adoption, like Joe said, in the States, here in Mexico, where advisors are kind of leaning more towards these model portfolios to allow them to scale more of their businesses?
Yeah, definitely. I think it's definitely one of our faster grower solutions right now at GBM. In regards to our whole asset base, it's still a minority of assets that are invested following models, but it's one of the fastest growing solutions and where we see more adoption. As you very well know, in terms of our internal advisor team, for example, they're already very geared towards using these models in terms of advising clients, building a portfolio, customizing specific exposures for each one of them. And as our pool of advisors has also grown at GBM, and we've seen people come from many different institutions, some of them following perhaps different approaches to building portfolios, and they've come across the variety or the different options that we offer here in GBM for these types of solutions. We're also seeing more and more of them adopting these types of strategies. We're, of course, far behind the trillions of dollars that you mentioned here in the U.S. in terms of the size of the solution in Mexico, but I'm sure that's something that's going to continue to grow a very strong pace going forward.
Yeah, I mean, in the 4 years that I've been at GBM, and especially the last 3 years, the adoption that I've seen from advisors using this internally, and the amount of time that they've been saving on things that they've used to be doing, especially in Mexico, a lot of advisors used to be stuck to their screens, having to make orders for clients or sell something or buy something, where now they're freeing up a lot of that time to try to really be more with the clients, maybe bring in more relationships, and just being more of an advisor.
And I will also say, going back to what Joe mentioned, we also initially launched this approach, for example, with our more retail clients, with smaller accounts, with a more even digital solution, for example, through a robo-advisor, things like that. But as we brought this solution into our pool of advisors and particularly into high net worth clients, we've seen even broader adoption and even, I would say, more success in this approach to running portfolios. And that also encourages us a lot in terms of the potential for the whole market in Mexico.
And then last question for you, Joe. Standard & Poor's, I think, makes tons of indices. How do these indices help advisors and their clients, would you say?
I think the indices, well, we know this from asking too. We and others run surveys around what matters to advisors when it comes to choosing index products. And what we hear as the number one concern is, or interest, I should say, is methodology. Advisors and their clients are very interested in how does an index run, right? What does it do? How does it add stocks or delete them? That is true of factors, sectors, countries, everything. Even the S&P 500, we give examples of stocks coming in and out. People want to know how this happens. And so an index provides, number one, transparency, which is something like 80% of advisors say that's what they're seeking. Number two is a level of history. There's a lot of data running back for us even into the 1800s, right? More than a century of data in some of our indices that an advisor or a model provider can use to really translate that into modeling out risk. How does this going to perform? How does it perform in different kinds of markets? And lastly, I think one of the things that we find is important is research and insight. SPIVA is one of the key pieces that we do that we know advisors rely upon to talk to their clients about indexing, to talk to their clients or investment committees about ETFs. And it really helps explain the themes of how these indexes work and also how they're behaving today. Because one of the things I think about a lot is that what does an index really tell you? It's really ultimately a rolled up ball of all of the sentiment, of all of the trades, of all of the people around the world in an asset class, telling you how they feel through a number. And that's happening multiple times per second per day. And so having that transparency allows a real microscope into global investor sentiment. And I think that's valuable for an advisor, and it's something we're going to continue to focus on.
Very good, very good. Well, Joe, thanks for flying down here and meeting with us. Andres, thank you for joining us, and thank you guys for listening in. Oops.
Hey.
Acá.
Muchas gracias Juan, Andrés, Joe. Ahora sí llegamos al primer break del evento. La siguiente hora no va a haber conferencias, es un espacio abierto para que puedan pasar al área de showroom, para que puedan pasar a tomarse un café. Aprovechen para conocer, para conectar con los partners del ecosistema, conectar entre ustedes, y nos vemos más o menos en una hora aquí en la sala plenaria para empezar ya con las pláticas y conferencias de cierre que sin duda serán los mejores. Nos vemos ahorita.